Now speaking, Paul Shepard, Vice President of FP&A and Investor Relations. Good afternoon and welcome. You can find our second quarter 2023 earnings press release on our website. Please note that the information presented today is unaudited and may contain forward-looking statements. These statements are based on our current expectations and involve risks and uncertainties. Please refer to our filings with the SEC for a detailed discussion of these risks. We may reference adjusted EBITDA, a non-GAAP financial measure, but please refer to our press release for a reconciliation to GAAP. Now, I'll hand it over to Ethan Brown. Now speaking, Ethan Brown, Founder, President, and Chief Executive Officer. In Q2, our net revenues were $102.1 million, down 31% YoY, but we made progress in reducing costs and cash consumption. We are focused on three pillars for future growth: value streams, inventory reduction, and restoring top-line growth. We are actively addressing the narrative around plant-based meats and releasing new innovations. Our products have clear health benefits, but there is misinformation and confusion in the market. We are countering this with research, certifications, and collaborations with organizations like the American Cancer Society and American Heart Association. We recently launched a campaign called There's Goodness Here to educate consumers about our process and ingredients. In terms of innovation, we continue to improve our beef, pork, and poultry offerings to be indistinguishable from animal protein. We have launched new iterations of our sausage and burger products, which have received positive feedback. We are also expanding distribution of our new BYND steak product. We recognize the need for a reset in the plant-based meat section of retail and are investing in in-store execution. We are working towards cost and price parity with animal protein and have already achieved this in food service. We are also exploring different pricing strategies to restore margins. Our products, like the Plant Nugget and McPlant Burger, continue to gain traction in international markets. Now speaking, Lubi Kudua, Chief Financial Officer and Treasurer. Q2 was a disappointing quarter for us as net revenues and gross profit fell short of expectations. However, we are making progress in improving our operating performance. Factors such as gross margin performance, cost containment, inventory reduction, and reduced cash consumption give us reason to be optimistic for the long term. Net revenues declined by 30.5% compared to the prior year period, primarily driven by a decline in the U.S. retail and food service channels. Pricing was also impacted by changes in product sales mix and increased trade discounts. Gross profit and gross margin improved compared to the year-ago period, but fell short of expectations. Lower materials costs, lower inventory reserves, and lower logistics costs were offset by higher manufacturing costs and lower net revenues per pound. Operating expenses were reduced by 33% year-over-year, primarily due to reduced non-production headcount expenses and lower legal and consulting fees. Overall net loss was $53.5 million in Q2, compared to a net loss of $97.1 million in the year-ago period. Adjusted EBITDA loss was $40.8 million, compared to a loss of $68.8 million in the year-ago period. Our cash and cash equivalents balance was $225.9 million, and total debt outstanding was approximately $1.1 billion as of July 1, 2023. Inventory fell to $207.1 million, demonstrating continued progress in inventory reduction. Net cash used in operating activities decreased by $24.3 million compared to the year-ago period. Capital expenditures totaled $1.8 million in Q2, compared to $20.4 million in the year-ago period. Total cash consumed in Q2 was $47.7 million, 49% less than the year-ago figure. We anticipate a return to modest year-on-year revenue growth in the second half of 2023, driven by newer products, international distribution growth, and progress with strategic accounts. However, greater than expected category headwinds in the U.S. result in a more cautious outlook for the year. We now expect full-year net revenues to be in the range of $360 million to $380 million, representing a decrease of approximately 14% to 9% compared to 2022. Gross margin is expected to be in the mid to high single-digit range. Operating expenses are expected to be approximately $245 million or less, and capital expenditures are expected to be in the range of $20 million to $25 million. Achieving cash flow positive operations within the second half of 2023 is unlikely due to the current operating environment. However, we remain committed to significantly reducing our rate of cash consumption and moving towards our goal of cash flow positive operations. In conclusion, while Q2 was disappointing, we are making progress in improving our operating performance. We remain optimistic for the long term and are focused on driving revenue growth, managing costs, and reducing cash consumption. Goldman Sachs analyst Adam Samuelson inquired, "Can you provide an update on the sales outlook, particularly in U.S. retail? You mentioned challenges in scaling trial and promotion activity. How do you plan to address this moving forward and accelerate volume consumption for future growth? What changes will be made in marketing, product, and distribution to achieve this? Ethan Brown replied, "Thank you for the question. We are confident in our ability to resume growth in the third and fourth quarter. We anticipate an improvement in gross margin as we move away from higher cost products and focus on cost reduction. Our operating expenses have decreased by 32% year over year, and we have seen a cash reduction of approximately $50 million. Our products continue to perform well, with our steak product, dinner sausage, and burgers all leading their respective categories. We are also introducing new and improved products, such as the Smash Burger and Stack Burger, which have received positive feedback. Additionally, we are actively addressing the ambiguity surrounding the health benefits of plant-based meat through research and partnerships, and we will be launching a more aggressive marketing campaign to highlight the goodness of our products. Overall, we believe that our efficiency, cost reduction, and messaging efforts will drive growth in the second half of the year." Luby Couture replied, "Given the challenges in the broader environment, we are facing some pressures that are impacting the effectiveness of our promotional spending. This is not unique to the plant-based meat category, as others in the industry have also reported similar challenges. We have learned from our targeted promotional programs earlier this year, which aim to attract more consumers to the category. However, we are seeing various factors, as mentioned in Ethan's prepared remarks, that are putting pressure on our category, including messaging issues. We are addressing this through our recent campaign and aiming to be more strategic in deploying our promotional spending. We anticipate seeing benefits from these efforts in the latter part of this year and beyond." Ethan Brown replied, "The key issue we are facing is the impact of the overall consumer outlook on our category. Consumers are trading down among proteins and buying less, which is affecting our high-priced products. Additionally, there is ambiguity around health, which further reduces the impact of pricing. Our focus is on restoring the category message and giving consumers a reason to come back. Once we achieve this, we expect our promotional activities to be more effective." Bank of America Merrill Lynch analyst Peter Galbo inquired, "Could you provide some insight into the revenue differences between the third and fourth quarters? Additionally, could you elaborate on the expected improvement in cash burn for the third and fourth quarters compared to the previous 12 months? Ethan Brown replied, "While we are not abandoning our focus on cash flow, we want to be transparent about the impact of our declining top line. It is unlikely that we will achieve our cash flow goal within the expected timeframe. However, we anticipate a significant decrease in cash consumption for the remainder of the year. Internally, we are actively working towards achieving our cash flow objectives. We prefer to keep this as an internal goal and provide more flexibility externally regarding the timing of when we achieve positive cash flow." Luby Couture replied, "We anticipate a similar revenue pattern in the second half of the year, with the third quarter typically stronger than the fourth quarter due to seasonal demand. As for cash consumption, our focus is on delivering on revenue projections and gross margin targets to generate gross profit. We are also containing costs, exploring opportunities to defer CapEx projects, and continuing our inventory reduction efforts. Overall, we expect cash consumption in the second half to be significantly lower than the first half. These factors contribute to bridging the gap." J.P. Morgan Chase & Company analyst Ken Goldman inquired, "Can you explain your strategy for R&D spending? Despite a decrease, it still accounts for 9% of your sales this quarter, which is significantly higher than other packaged food companies. Given that you believe the biggest issue in the category is a misperception of health benefits and recent product launches have had mixed results, why not allocate some of the R&D budget towards brand and category building to address this issue more effectively?" Ethan Brown replied, "We are prioritizing spending on the category narrative and collaborating with other companies to address this issue. We are reallocating funds towards marketing to improve our messaging because it is primarily an education issue. The health benefits of our products are well supported by research and we have seen positive changes in consumers' lives. While I cannot disclose the exact allocation between R&D and marketing, your emphasis on this matter is correct." J.P. Morgan Chase & Company analyst Ken Goldman inquired, "How are your recent sales trends for meat eaters, flexitarians, and pure vegans? Specifically, how are vegans responding to your marketing efforts compared to previous periods?" Ethan Brown replied, "Our focus is on highlighting the health benefits of our plant-based protein compared to animal protein. We see a mix of basic flexitarians in our consumer base, which aligns with our target market. The main challenge lies in expanding the overall market size and attracting new consumers. We are actively collaborating with other companies to address this issue and drive growth." TD Cowen analyst Robert Mosca inquired, "Do you consider the possibility of the business becoming a $300 million or $250 million business in your long-term scenario planning, given the challenges of consumer perception and environmental concerns? Would you ever consider right-sizing the company in that direction?" Ethan Brown replied, "Our company is well positioned for future growth, as evidenced by our consistent quarter-over-quarter growth and successful market penetration in key regions. In Germany, for example, we have seen high consumer acceptance of our plant-based burgers and nuggets, with 1 in 5 signature burgers at a major global burger chain now being plant-based. Additionally, we have recently launched with McDonald's in Malta, further expanding our market presence. The trend towards plant-based alternatives is not limited to Europe. In the US, younger consumers are increasingly embracing plant-based options, while major food providers like Aramark and Sodexo are committing to increasing their plant-based menus. This trend is driven by a growing awareness of the environmental and health benefits of plant-based diets. While there may be some initial distortions and challenges associated with this disruption, history has shown that such disruptions tend to align with consumer demands over time. As a company, we are focused on improving efficiency and reducing costs to ensure we are well prepared to meet the needs of consumers when they are ready to make the transition to plant-based alternatives. Overall, I do not see the trend towards plant-based alternatives reversing in any way. The common crisis of sustainability and health concerns is driving the need for food solutions that address these issues, and our company is committed to being at the forefront of this movement. DIG analyst Peter Soleil inquired, can you provide insights on the disparity between your success in international markets and the ongoing sales pressure in the U.S.? Are there any learnings from international markets that can be applied to the U.S.? Specifically, what factors are driving better adoption and sales in international markets, such as Germany? Ethan Brown replied, in Europe, there is a strong focus on climate and environmental concerns, which has led to a greater emphasis on changing food as a way to address these issues. The government and consumers in Europe are particularly concerned about greenhouse gas emissions from animal protein, such as nitrous oxide and methane. By shifting towards plant-based alternatives, they believe they can effectively reduce these potent emissions and buy time to address the climate crisis. In the United States, the focus is more on health, and there has been a decline in the perception of our category as healthy. Competitive marketing efforts have contributed to this shift, and now we need to work as an industry to regain consumer trust. The main difference is that there is a clear and compelling reason for the adoption of plant-based foods in Europe, while in the United States, we need to rebuild that perception. That's exactly what we are doing. DIG analyst Peter Soleil inquired, has the decline in the perception of the 50% figure to 38% continued in 2023? And what measures do you believe are necessary to improve this figure? Ethan Brown replied, I believe that the trend we are currently seeing in second is reaching its peak and will soon start to reverse. As the medical community and others begin to question the extent to which second is being used, there will be a pushback. However, it is important to note that second is a valuable tool in combating diabetes and cancer. We have seen positive results in our certification process and the work we are doing in the field of cancer. Additionally, there is ongoing research being conducted both within our company and in the broader industry that will contribute to the improvement of second. While there may be some short-term challenges, I anticipate a rebound in the future. Barclays analyst Ben Thur inquired, can you please explain the difference in performance between Foodservice International and Foodservice US? Ethan Brown replied, in terms of consumer receptivity and readiness, we see strong potential in the EU market. Our studio partners are recognizing this and focusing their efforts there. However, it's not a binary issue, but rather a matter of timing. We anticipate a resumption of activity among QSRs in the US, which is something we feel confident about. This aligns with the larger trends we discussed earlier. The category experienced significant growth and excitement, followed by a period of decline, and now we are on the upward slope of enlightenment. We are optimistic about the remainder of the year, as we expect to see modest growth that indicates our emergence from this challenging period. Piper Sandler analyst Michael Lavery inquired, how do you plan to prioritize taste in product development to cater to the majority of U.S. consumers who prioritize taste over health benefits and price? Can you provide insights into the potential advancements in product development that could significantly impact a large percentage of U.S. consumers? Ethan Brown replied, our focus is on striking the right balance between taste and health in our products. We have received positive feedback on our new sausage, Sausage 3, with some consumers actually preferring it over animal protein equivalents. Our goal is to educate consumers about the health benefits of our products and lift any cloud over the sector. Once consumers understand the benefits, taste will become a more important factor. We continue to improve our products, such as our new burger with a new flavor formula and texture that has been positively reviewed. We are committed to delivering on taste and health, which are key motivators for the U.S. consumer. Jefferies analyst Rob Dickerson inquired, is there a specific factor driving the expected growth in U.S. retail revenues in the second half of the year, considering concerns about consumer strength and student loan payments? Ethan Brown replied, there are a few factors driving our growth. Firstly, we are benefiting from lower year-over-year comparisons. Additionally, we have seen increased distribution in both retail and food service sectors, both domestically and internationally. Our strategic partnerships, especially in Europe, have also contributed to our success. It's important to note that this growth is not solely reliant on a positive consumer outlook, but rather a combination of these tactical factors. Jefferies analyst Rob Dickerson inquired, "Can you provide more information on the impact of the new Smashburger taste profile on your advertising strategy and how you plan to communicate this change to consumers?" Ethan Brown replied, "Our current focus is on addressing the health narrative and cleaning up any associated issues. Our marketing efforts for the rest of the year will primarily revolve around this theme. In terms of future product releases, we aim to generate excitement and engagement similar to any new product launch. However, at the moment, our priority is to address the broader category issue. Once we have resolved that, we can allocate our resources more strategically." BMO Capital Markets analyst Andrew Strelzik inquired, "What are the current competitive dynamics in the category, particularly in light of the trade discounts you mentioned? Are you experiencing increased competitive activity and intensity? How do you anticipate this evolving in the future? Additionally, which of the headwinds impacting the quarter do you expect to persist versus moderate throughout the year? And within the high-level buckets, where do you see the greatest potential for margin expansion?" Ethan Brown replied, "In terms of margin, we experienced some temporary issues related to inventory last year, which impacted our production and resulted in underutilization costs this quarter. However, we do not expect these issues to recur at the same level going forward. We are confident in the balance of the year and anticipate improved cost of goods sold (COGS) performance." Regarding the broader category and competitive dynamics, our focus is on getting the category message right to attract new customers. Continued discounting, whether by us or our major competitor, has led to trading among consumers rather than driving overall growth. However, we have benefited from a significant shakeout in the category, and we remain strong. Our product quality is improving, costs are decreasing, operations are becoming more efficient, and our strategic partnerships are progressing. While we acknowledge the presence of a strong competitor, their presence is ultimately beneficial for the category as a whole." Ethan Brown replied, "Thank you for your continued support. While this quarter presented challenges, we are optimistic about the second half of the year. We anticipate a return to growth and are confident in our ability to climb out of this situation. We look forward to sharing our progress in the next quarter."